and then go back to traditional DeFi. But the most important part is liquidity pool and mining. Actually, this is enabler of the DeFi. So here is a more mathematical and quantitative rather than qualitative, but you need to understand, at least at the level of some math, and then what they're meaning, and then how they interpret it for your business. So three important topics that I'm going to talk about is bonding curves, and then market makers through the constant function. This is a well-known Uniswap. This is the most famous liquidity pool project, and the curve finance, and then also balancer, because the balancer is the one actually I favor most. And then also you know about the yield farming, and then how you can do in the more like a long-term way, because recently there was a lot of the issue about the yield farming. The most of the one was a short-term like earning, but you need to be carefully designed to have a more long-term ROI for this space. So I'm going to introduce that aspect. But this part is a little bit maybe boring if you're not familiar with. And then this part also I spent a lot of time to try to understand what the behind the scene, and then how I can apply to develop or design a new project. So this is very important and a key part. So the first one actually, they call automated market maker, AMM, was a banker, and the banker use a bonding curve. Here's the concept: is a bonding curve is a bond something. Is usually the bonding means that they bond two variables. So this is a mathematical term, but actually this is one used and most used in DeFi projects. So you need to understand this bonding curve. So bonding curve allows continual liquidity of a token with the price change depending on how much buying and selling activities is conducted. So actually this is one actually automatic liquidity pool formation and operations through the bonding smart contract. So this part actually you implement in smart contract, your smart contract. So for example, the older Ethereum based project, you can go to either scan and then type some token or some of their contract numbers, and then you can see all their smart contract in Solidity files, and then you can look at it, how they actually implement. So that's one actually the most important part if you want to be a good designer. And then here is one example that you should understand is a banker implement some concept like a connector way. Actually, this is a reserve ratio. Reserve ratio means that you have a liquidity pool. So liquidity pool means that you have tokens in the liquidity pool, and then you can measure how much the ratio in the liquidity pool balance with respect to the bonding token. Bonding token is usually what this means that for example, you have a liquidity pool, how you can make, and then the way actually is to you provide your token like a DAI or the USD, whatever you put in the liquidity pool, and then the price is determined by this bonding curve, and then at that price actually you can mint new token. There's a bonding token. So this is one of the some proof that actually you deposit, it's like a bank deposit, and then you get the for example, you have account, you will have a how much your balance in your bank account is the same thing. So you will provide by the token. This is a bonding token, with respect to this, how much you reserve, you collateralize your token to this liquidity pool. So it's a definition. So it's the ratio between the collateral token balance. So how much the total balance of your reserve or collateral token in the pool divided by the how much actually you minted your new token by depositing your collateral token. So this is a configurable constant. Means there's a constant, but you can change for your purpose. So actually the bonded token price can determine, because this is a preset constant. So they are depending on that the liquidity pool balance and the bonded token total supply. So how many tokens you supply with respect to the how much actually the token you reserve. And then depending on this number, actually they can be like a fixed one, linear, or some exponential like increase, concave upward or concave downward, so increasing function like that. So this determines your price and your supply of a token. So you can determine, you can actually design at the design stage for your business purpose, what kind of this CW, or what kind of the like, for example, this kind of the bonding curve you are going to use. This is a very important topic you need to understand. And then liquidity pool design wise that, so this is a liquidity pool design, means this how you can design smart contract. So bonding token price function, for example, that as a function of this some mathematics, like a power function. And then you can have a relation between the all I define in here and then with this function. And then this CW is depending on, is related to this exponential parameter. So they determine the family of curves, what type of curves they are related, not the slope. And then also if you put into some numbers, and then they explain then how you got this graph here by using this formula. So actually this curve means that you have this bonding curve, then you have a token supply, and then area under this curve is a total balance of your liquidity pool. So this is the one actually that you can use all the formula that you can prove. Actually, that you can prove this one by, if you it's like high school, like some mathematics, but actually I'm omitting that process, but you can prove everything. So in the design wise, that there is several free parameters that you can change for your purpose, is dynamically adapt to different bonding curves of different token asset types. So this is the one actually you can choose that depending on your project. So you can choose your different type of the bonding curves, and then also price change to adjust inflation or deflation of token supply. Actually, this is a part of the like a token design. So actually the providing token that actually that means that incentives, so that how you can provide incentives. For example, inflation means that the only participant, only that you are the person actually putting your token to liquidity pool in early, and then you have a benefit, but it's like exponentially increasing your value. And then also you don't want that one, then you can deflationally. That means that you can provide the incentive, but not increase, but not exponentially. So some reasonable way to benefit for the early participant. This is one. So for example, that this part is, if you put into your token in here, and then if you put into here, if you put in here is early part, and then the token will be price will be light, so you will get benefit in the later participant. So this is where actually that you have a benefit if you participate early here, and then your token later, your token price will be rise here. So you will have a profit from this rate. This is the characteristic of bonding curve. And then here is maybe many people in DeFi space are interested in. This is recently in blockchain, and there are a lot of the interesting in the non-fungible token, and then we heard about a lot of news in relate to these non-fungible tokens. But you can also design your NFT DeFi project using this bonding curve. So this part it's worthwhile to understand carefully, and then you can design your NFT based DeFi project. So we call like a tokenization of NFT. Actually, NFT itself is a token, but the tokenization of a token here, that meaning, the meaning is actually the NFT is a non-fungible, so they have a unique value. So for example, in the Ethereum standard, you can develop using ERC 721 or ERC 1155 here. But this is one actually the ownership of a specific asset. So non-fungible means that it can be replaced by any other one because this is unique and cannot be easily interchanged, a similar identity or identical value of NFT. So this is unique to this NFT. But if you want to use NFT in DeFi, actually the easiest way is to use bonding curve. So actually you first form an NFT for a specific asset. So this asset means they have a unique characteristic or unique value. So you can put in the like some specific ownership into this token. So and then you can trade NFT using token bonding curve. So you use this as a collateral, and then in the bonding curve, actually if you want buy some partial ownership of this NFT, and then it's the same mechanism as I did here, that you put your collateral, and then you can get the partial ownership of this. So this is one actually that I'm designing some project. I'm also a patent attorney, so I have involved a lot of the patent monetization project like licensing or intellectual property like a copyright or some of the like all the like intellectual property copyright or other like for example you can publish a book or something like that, and then trademark. And then mostly I'm interested in patent. You can make, they have a unique value. So you put into there is a NFT, and then you can like monetize your IP token is a IP NFT using this concept. So this is one actually that I'm going to do another more detail in another webinar. And then actually I'm now under development. So this is a very, very interesting topic. And then, so price set by pre-selecting bonding curve. So price that you can actually preset using this bonding curve. So makes sense that what the NFT underlying asset it relate to this price. So you can, this is a design choice. So you can select your design. And then here is some like NFT finance. Actually, they provide some platform that you can put your some NFT and then select some pre-select like a bonding curve, and then you can place your NFT and then you can trade it. So this project already is ongoing. Or the other way actually that you can do to DeFi integrate to NFT is a Recti in ERC20 tokens. So it's the same thing like if you already know about the Bitcoin, then how you can put in Bitcoin in Ethereum network is the way is that they develop like a rapid Bitcoin, and then put into your Ethereum network. So actually, you can trade your Bitcoin in Ethereum network is a rapid tokens concept. So this is the same thing, and then using AMM and everything is the same thing. And then you can using licensing, leasing, or renting, whatever you want. Okay, so another beauty part, actually, I also that integrating this concept to my business is data tokenomics is they can use for fundraising. There is a concept, actually. So for example, you know that recently there was a COVID-19 vaccine, and then that's a good news. And then usually that here is an emergency situation, so they develop in a very short time, but usually they're developing that kind of vaccine is over the 10 years usually, and then new drugs it usually take more than 10 years, at least 5 years. It's a long-term project, so financing is always an issue. And then, but if that project is very unique, for example, like COVID-19 vaccine is very unique, and then you can put it as an NFT. The project itself can be non-fungible token, and then you can develop your bonding curve, and then let investors invest your liquidity pool using this bonding curve concept. So I think this is very beautiful concept that I'm going to explore it, and then you can also using for yours. And then also you can like a gaming project on our other project, you can use this NFT concept. And then so actually here I provide some example. The actual projects is blockchain Cuties Universe is a collaborative game. So actually that they integrate DeFi NFT using this game space, and NFT fee is a loan project, and then using NFT as a collector, and then into like a money market in the branding project. And then NFT says is the same thing, but here is a famous like crypto kitties and other like digital art collaterals using put into your liquidity pool as a DeFi project. So I think that this part was it will be very interesting part, and then a lot of the application will be possible. So this part will be for designers should be noticed and should understand, and then apply it for your project for this space. Also, here is I think that this most famous concept is here is a constant function based AMM, and then maybe most of or many of you already knew about this part is a Uniswap part is they call it like there's a constant product. It's a function is there are several ways like a Uniswap. Here is a constant function, and here is the constant sum, and here is a hybrid one. And then so this is how they actually make this liquidity for working as automated ways to like the changing of this pair of two tokens, and then they can, if you exchange working, that you exchange one token by another, and then they will change the balance in the pool, and then the way actually they control this the balance of this pool is by way they changing both tokens by using this. This is another type of the bonding curve actually. So relation between Y and X. So two tokens. The previous bonding curve is a relation between the price and supply. Here is a relation between two token price. So this is another type of the bonding curve. And the Uniswap is very well known. And then the curve finance is another one. And then balancers, constant way to mean this AMM is a recent one, but this is very powerful because the reason is that here is some formula. Then you can look at it in their white paper, but the beauty is that actually they can use many tokens in a, for example, this traditional liquidity pool only has 2 tokens in a one pool, and then their ratio is 50 to 50 here. But using their balance constant way to mean AMM, you can change this ratio whatever you want, and then you can increase your number of tokens. Actually, the up to now there is 8, but you can, this is a design parameter that you can choose whatever for your purpose. So actually, for example, that for 2 tokens is somewhat different from Uniswap. The Uniswap is XY is constant, but this is a square root of X and square root of Y is constant. So very similar, a little bit different. But in actually, if you have 3 tokens in your pool, then here is a surface in 3D space. So you can increase more dimension in here. So the design wise, that here I want to show something that actually to have in mind, and then apply to your this liquidity pool design, that how you can implement a smart contract. So one is that hybrid one. Why use corporate finance use hybrid one? Because of a slip fees. So slip fees means actually there is a difference between the actual expectation of your price and actually the executed price. And then always there is a slip easy in the traditional way. So what they did was actually the constant sum market maker as a 0 slip easy, but the limited liquidity. And then so that actually what they did was a hybrid function. So they combined with the constant sum and constant product, and then the way actually do is a balance. So between the 2 tokens. So actually the shift towards a constant product as a portfolio become more imbalanced or optimized for the slippage loss. So this is a design parameter you should know about it. So adaptive constant function type for different token asset type. Here is you have in mind that. And then one drawback, the serious drawback using this AMM is impermanent loss. That this is well known in our DeFi community. Then the way actually the hedge, the mitigate to this side is like co-finance using the similarly priced asset. So like a stable coins or the tokenized Bitcoins, a little bit like a more stable to pair up the token, and then you can minimize impermanent loss. Maybe you already know about impermanent loss means actually that if you hold your token and then you put it in your liquidity pool, actually there is always some loss unless you have a gain through some like, for example, the pool provided some users to the like a stability fee or some other like a fee to use that pool. So that will be the earning. So actually the issue with this AMM based liquidity pool is impermanent loss. And I'm going to get into this topic again later, to how actually to mitigate impermanent loss. But there is one way is that, but the only you have limited to your use of the token to the similarly priced asset is a trade-off. Means that you cannot use like many other tokens. So there is a trade-off for tokening for a market design. So here is a market design means that you need to be make more extendable market, and your liquidity pool should be more different, so more liquid. So this means that you should be trade-off to hedge, to mitigate this impermanent loss here. Here is another concept actually that you should know about is this bonding curve here that I use just one curve here, buying or selling. Buying means that you put into your token in your liquidity pool, then you provide your token. And then selling, and then means that you want somebody put in your token, and then they wanna have the original back to their token. Actually, that means that you provide one, and then you like a bond, you bonded the token here. So, but they moving along the one curve here, but in the design wise, you can make two bonding curve for buying side and sell side. So the different price curve for buyers and for sellers. Actually, the way that actually you put this design is that the difference between the separation, if you have two curves, and then there will be the in between there is area that in the bonding curve, in the buying curve and sell curve, and then there will be the accrued to the smart contract. That's a earning to the smart contract. So you can use it for whatever you want. So if you want to design this way, then you can have some specific purpose of doing that, and then you can utilize these values in the smart contract for your purpose. So this is the one, and then you should know about it. And then finally, here is a more advanced topic, but you know about is that there are recently there are many derivative market is going on in the DeFi space. And then, for example, but if they are related to time, so your value changing with respect to time, usually the futures option is the same thing. And then traditional AMs cannot handle this. So you need to put in the time dimension. So one way is to put in the time in your AMN curve here, like that, or just combining two assets. So because all the derivative have their underlying assets. So derivative means that derived value from your underlying asset. So you can combine them, and then you can handle them like a banker's constant way to mean AMM. So this is advanced topics, but it's worthwhile to understand this one. And then yield farming as a tool for bootstrapping liquidity. This topic actually there are a lot of you can have information is Googling of this space, but I'm mostly interesting is that whether this can be not just for the short term, but how I can make this one as a long term. So actually the persistent the operating business in DeFi space. So here is one example that Ideal Finance is they put in like a automated asset allocation aggregation strategy. So they put in like a best yield. So is a highest interest rate or the risk adjusted. So actually the in between risk and the yield. So for design wise, this is a rebalance system. So automatically rebalance between underwriting providers to maintain highest rate optimal risk return allocation. And then ETF type is also is a way to actually the users can be like a passive way to earn your investment. So here is the same thing that you can provide like as a long term. So you put in like ETF type DeFi index fund using the money market, and this yield farming with more long-term project, how you design this as index function for ETF type for this yield farming business. So this is one you have in mind. Okay,